Hey everyone, Value Add Mike here today to discuss how to stress test a deal. For those who don't know, my name is Value Add Mike Taravella, and me and my business partners have closed over $65 million in commercial real estate, specifically in the multifamily sector. And today I wanted to discuss how to stress test a deal. And with the world ending, rates rising, rents are going to go down, rents are going to be nothing, I wanted to reassure that everything is going to be okay. Cycles happen. This is a normal part of the business, but we really want to make sure we're playing defense with our underwriting in the next few years to make sure that we are optimized for the years after so we can have hypergrowth together. And so the first thing that I do when stress testing a deal is if I see a deal with a refinance, I eliminate the refinance altogether. The reason for that is because with that refinance opportunity, it injects a lot of money into the deal and returns capital to your investors on the underwriting. But I want to be sure that I can tell my investors confidently that if the world ends and banks don't want to lend, that we can still survive the deal within the 5 to 7 year hold period that we have. And so I'm generally looking for like a 5 to 7% cash on cash during that hold, even with the original acquisition financing, because it really allows me to ensure that I can have longer term debt, fixed rate for a long period of time, and generally lower leverage. So I feel much safer not being over levered during a recession. So I just really want to make sure that we're doing right to our investors. And great, if we get a refinance and we can return almost all of our capital or 50%, whatever that number is, great. But I want to know as an operator that I can sleep easy at night knowing that we're paying our investors a consistent return and not hitting grand slams on an underwriting and not in real life. So that's the first thing I do. The second thing that I do is I compare rents. I look at the rental market and I say, okay, here's the market rent, and I look at market rent in terms of what are market rents today, not 3, 5, 10 years from now where I'm speculating where rents could be. But if rents are today, where are they at? And then I see where my cash on cash numbers are and see if it exceeds our DSCR requirement. But what I next do is to find the floor of the deal of how little money you can make is I take today's rental income number and I make that our market rent and see how little money we can make. The goal, optimally, if you break even, that's probably the best case scenario. You may lose a little bit money, but I want to know what is the worst case. We can't increase rents because sometimes that happens, especially during COVID. So I want to make sure I talk to my investors and say, this is the absolute worst case when it comes to underwriting. If we can't increase rents, I assume my taxes go up, my insurance goes up, my operating expenses are optimized for how we operate the property, and just being sure that we can survive that fund. It's a tough conversation and the deal never looks great, so I want to be very transparent with that, but I just want to know where the floor is when it comes to doing that deal. And then lastly, what I like to do when it comes to stress testing a deal is playing with the exit cap rate. And so I really look up to Nikolai Ray. He's a phenomenal investor and educator when it comes to exit cap rates. But generally what I'm looking for is to see how high does the cap rate need to be to see if I can exit the property. So right now we may be in a market where we could sell the property for $120 a door, but how high does that cap rate have to be and that dollar per unit exit price have to be before the deal goes bad? Because once again, the objective of stress testing is to see how low it can go and see if we can still make money. But like we said, we're still optimized for cash on cash and making sure that we can pay distributions. So it's not like a ripcord. We have to make money in the next 6, 12, 18 months, but it's just making sure that it pays over time and make sure we can survive in advance. So I try to see what's the lowest per door price on that exit, and I see if that's still below replacement costs, and just really make sure that we understand the floor, but also understand the ceiling, right? Because you can get in your head about make every deal look really bad if you do all three of these things. But I generally like to look at the floor and the ceiling in all these instances, and then I ask myself this one question of how does the deal go wrong? And I think a lot of people and a lot of operators can talk about the upside, But really, it comes down to a couple factors and making sure that you can protect yourself in this next cycle or what's going on in your market and submarket. So asking yourself, why does this deal fail, and asking your operators how they're circumventing that risk is a very powerful way to make sure everyone's on their toes and making sure that they can play defense as well. So if you got any value from this video or the channel, please like, comment, and subscribe. Happy to answer any and all questions you may have. And in the link below, you can see subscribe to our investor forum for investor updates, newsletters, and opportunities. And until then, we'll see you next week.